All right. Welcome everyone to this week's webinar. I am Riz here. I'm going to be hosting today's webinar. Usually my man Chris does it, but he's running a bit late. I'm sure he'll be joining us soon, shortly. But until then, I want to kick things off, really starting going over what is going on with the market. We know obviously that, markets have been a bit volatile, the last few days, but it's not as bad as people are making it out to be. I don't know what it is, but every time we get a little bit of a drop, whether it's 0.5% or even 1%, people start panicking and having all kinds of reactions when it's only a 1% drop off of a monster rally since last year, March, right? So I know there's a lot of stuff on my screen, so bear with me. But in fact, actually, I'm just going to run it the way it is. Take a look at the S&P 500 index here. Don't worry too much about these kind of candles here. I'm actually going to hide them, just so there's less noise, and ultimately make it easier to kind of digest for people on the stream and less confusing. So what happened this week? We know that the markets had continued to run up. In fact, on I think it was Wednesday, we pretty much an intraday all-time high. Okay, on Wednesday. It's only on Thursday and Friday did we have a bit of a freak out with the sort of market sentiment. And why? Well, I mean, it shouldn't come as a surprise if you've been paying attention and kind of either on the live streams or paying attention to what I've been saying in Elite. You would know that the market is a bit on edge because of the 10-year Treasury bond yields. Okay, the 10-year Treasury bond yield is something we will briefly touch on, but right now, as I break down the S&P 500 kind of technicals here, we aren't looking the best, but guess what? We're still okay. We're not, we're not looking to really get back into the 3758 area support or 3755 area support that I had marked, a couple of weeks back. But ultimately, I have said in the chat room, we need to kind of be careful of this 3850 area. Okay, remember, these technicals and all these kind of levels are not set in stone. They are not precise to the decimal. Okay, they're a area for a reason, right? So the 3850 area, I'm gonna try and mark it here for you guys. I mean, just to make it easier. So you want to pay attention to this area here. Okay, and I'm going to do a full-on technical analysis, kind of break down why, but this is the kind of the area you want to watch out for. Okay, 3750, 3760. Okay, if we see a break below, especially this week, right now, I'm going to take a look at what futures are. Granted, it doesn't really matter too much. Futures are about down 0.10%, so 10 basis points, not too big a deal. Of course, we know that in this market, we have a lot of reversals, right? You can see Fridays pretty much looks like a what's known as a doji, right? Just very, very flat, long tail, right? Look at the wicks. A lot of range in that day. That's what had people spooked on Friday a bit, but ultimately went slightly just break even-ish on the day, right? But still not the greatest of bullish moves, although we were able to hold the 3900 area. Keep in mind, we don't need to worry what happens overall if we have solid positions, which we do. I pretty much, I remember a couple weeks back, I had Space, Virgin Galactic, and Lemonade that I took delivery of due to short puts, and I luckily, got rid of them, made money taking delivery, made money on the stock, plus made money providing delivery because I did covered calls and got assigned. And you know what? That kind of trade is really win-win-win, and it doesn't always go that way, but it did for me. So right now, I only have those solid positions, and I've sent that list of companies. I've sent that update on the stocks that I hold in my trading account. So it shouldn't be a surprise that they're all pretty solid. I can sleep easy at night. You should be able to sleep easy at night, regardless of whether markets, stay here, hit all-time highs, or pull back to around the 3850 level. I'm sure we are okay for the time being. Let's flip over to what's going on with different sort of time frames here and sort of market sectors. So let's pull back the asset classes first. Okay, we're going to take a look at the 10-year Treasury note yield. Take a look at this. Okay, TNX top left. Okay, as I mentioned, 1.73. That's the Treasury 10-year Treasury note yield. Okay, not the price. So why are yields going up? A quick crash course. 10-year bond yields are considered to be one of the safest. Think of it like investments, quote unquote, the most stable. Okay, investments, not only for people like you and me in retail, but for institutions. In fact, for countries. Japan, China are actually, or just to name two, are one of the largest holders of the U.S. Treasury bonds. What's been happening? I can tell you over the last few weeks, even a few months, Japan specifically has been unloading the 10-year Treasury bonds. Why? Okay, why do these countries hold these bonds? As a safety net, because everyone knows the US dollar, the US is essentially, the world leader, right? The US dollar is essentially the world reserve currency. So it makes sense to have, for countries, exposure to the US via the Treasury notes. Okay, these are Treasury notes, Treasury bonds. These are bonds issued directly by the federal government. Okay, so when we see the yields go up, what does that mean? It means the bond prices are coming down. It's essentially like a dividend yield. If a stock price comes down, the yield goes up. Okay, the return on the interest, in this case for bonds, remember, bonds pay out interest, goes up. So the interest received is going up because the bond prices are going down. Okay, so this is a quick crash course. What does that mean? Why are bond prices going down? Because maybe some institutions and different countries are selling them. They're closing out their 10-year Treasury bond positions, and they could be for many reasons. But ultimately, once you see bond prices drop, yields going up, markets are thinking, well, wait a second. Are countries and other large institutions getting rid of these Treasury bonds because they want to maybe decrease their exposure to the U.S. and U.S. Debt, U.S. Think of it like the U.S. Treasuries, essentially, which is one of the most safest kind of investments. They want to pull back for whatever reason. Or is it because institutions and these global worldwide countries from all over the place, do they feel like inflation is going to be increasing? So the market and its participants are spooked for that reason. Perhaps, remember, not a guarantee, perhaps we are going to see a resurgence in inflation. And I've said it over the last year. Inflation, every time I've talked about it up until before March, before mid-February, before March, I've said inflation is not an issue just yet. Okay, inflation is not an issue just yet. And guess what? When it does become an issue, we will talk about it. When it becomes something that the market is concerned about, we will talk about it. And guess what? We are talking about it. Okay, we're talking about it right now. In fact, I've been talking about it for the last 2-3 weeks, more so than prior before. Why? Because it is something that the market cares about. Remember, the market has many different walls of worries. Before it was COVID, then it was the economy, then it was is a vaccine. Now it is inflation and 10-year bond yields, which have been going up. And as I've said before, it's not that they're going up. It's also the fact that the trajectory that it's going up with, right? It's going up seemingly very, very, with a lot of momentum, a lot of force, a lot of velocity. And in fact, we are now at the January 23rd. So we're like about 13 to 14 month high, okay, on the Treasury yields. The last time we had a 1.73 kind of Treasury 10-year bond yield was in about January 22nd. Okay, 2020, before the pandemic, okay, last year. So something to keep an eye on, and that's why markets are factoring in a bit of an increase in inflation. Why? Because we know it's not it's a meme, but really there's some truth to it, that the money printer just hasn't stopped. And whether you want to blame the Fed or you want to, blame, whoever, ultimately, Stimulus has been pumped into the market. By market, I mean in the hands of the individual, even corporations. And it's, there's 1.9 million trillion stimulus that's kind of gone through and passed. Isn't the first one, right? I mean, I don't know if it's going to be the last. I think so, but who knows at this point? But it's not the first one, right? We've already had trillion or more in previous stimulus already. So the market is thinking, with all this money being printed and pumped into the economy, pumped into the hands of individuals and corporations, it's going somewhere. It's going to be spent. And where is it being spent? On different things, right? And when money is spent en masse, what happens? That increases the demand, right? When demand increases, prices increase. Okay, if the supply stays the same. This is what inflation is. The cost to purchase something going up. Not because anything's changed with the product or service, but simply because there's more demand and prices are going up. This can be relevant to the price of a Big Mac. This can be relevant to the price of a bag of milk. This can be relative to the price of a Honda Accord. This can be relevant to pretty much every facet of our lives. Whether it's the price of commodities like gas, whether it's any kind of materialistic item that we purchase, right? So that's where inflation really is. It's the erosion of money. And when we see inflation go up, other asset classes like stock markets pull back. Why? Because they are discounting growth. And I'm not going to, do a lecture on the discounting factor of growth and the impact it has on growth-based companies in detail. But simple answer to anyone that asks or is thinking, well, higher inflation means, drop off in tech. Not only tech, any growth related companies, any company that is borrowing significant amount of money, any company that really generates not much positive free cash flow because they're dependent on lending. And when bond yields go up, ding, 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 what else goes up for those of you that are smart and have been paying attention? So do potential rates. So do costs of borrowing. Okay, so this is what the market is afraid of. Okay, moving on to oil. I hope again that this kind of insight into how bonds, how it impacts markets. This is stuff you won't learn in your economics 101. Most likely, these are things that you probably won't learn from your trading guru out there or on Instagram in detail. Okay, these are things you have to kind of unfortunately learn and go through and understand as it happens. Okay, and here we are. So with oil, okay, oil had a pretty big dip on Friday, but we are looking pretty good at $60 kind of support area. Not a bad point for price per barrel. Again, I said $60 area, 60 to 65 is my kind of base case equilibrium level. And here we are. Take a look at this. We hit very close to about $65, $66, and we pulled back, right? So you can look back at the recordings. I've been saying it, since oil was around $35, $40, that it could continue to go up, and we would see this kind of level. And I didn't play it via ETFs or direct commodity futures contract. But of course, if you had been watching my portfolio from last year, you would know I had significant oil positions, well, direct exposure to oil producing and oil exploration companies. Okay. Although I have been winding that down on the run up. Gold, take a look at gold. Gold rally from last year has been fizzling out. Okay, no surprise there, but it has bounced up from the 1700 level. 1700 area looks pretty good for a nice long-term support. Okay, and guess what? When we have inflation increasing, what does that mean? Usually, all things considered, remember, there's no direct correlation, but all things considered, when we see an increase in inflation, we see, okay, that the price of commodities in general, not just oil, but price of commodities in general go up. Gold included. Okay, gold is considered to be, okay, a bit of an inflationary hedge. All right, so something to keep in mind. We might be kind of in that sort of area where maybe we see gold prices inch back up, maybe towards the 1800 per ounce level. Who knows? Something I'm keeping an eye on. I don't have any direct gold or metals positions currently. Okay, for transparency. Last but not least, the U.S. dollar index. Okay, this one, the U.S. dollar is actually holding pretty well. Remember, this 91 level is just relative to a whole bunch of wide array of global currencies, not necessarily to one specific currency. We don't really care about the number per se. We care about if it's going up or not and what's kind of happening with this chart. And all things considered, we're kind of moving sideways in the U.S. dollar. So not too bad. I think that's pretty stable for now. Okay, something we have to obviously keep an eye on as things go. I will get to some of your guys' questions. Chris, I mean, I know you're muted right now, but if you did want to chime in, absolutely, with voice, it's fine. I did see your question on stimulus passage, and of course, I think I also answered it in a roundabout way, where stimulus does, of course, factor into inflation and inflation fears. How much exactly? We don't know. We're in uncharted territory. Okay, we're in the Wild West, so to speak. No one has ever done this kind of, or no time in history have we done this level of stimulus, this level of money pumping. Because guess what? We haven't seen a global pandemic in my lifetime or in the lifetime of pretty much anyone who's alive today. So guess what? We are really, really kind of taking things as they go, and no one really knows for sure. There's no blueprint or kind of history books to kind of look at. But we do know, all things considered, based on economic and monetary policy, that inflation can go up. And a 2%, sub 2% inflation rate is what the Fed is looking for. It's not there yet. And if we do get there, it doesn't mean, the world is coming to an end. It's okay. The markets will get past this wall of worry. All you need to do is hold some amazing companies, okay, that are not just solely growth companies, okay? It's fine to have growth companies, but that's not the only thing you should be focused on, of course. Here we are with, I'm going to pull this year to date, and this is the S&P 500 sectors. Look, take a look at energy pulling back, still the leader. Not surprising. It's been the leader since pretty much February onwards. Okay, we can see this yellow line up here, pull back about 30%. This oil energy ETF, okay, is about 30% year to date. Okay, followed by XLF financials. Okay, many financials companies, whether it's like banks, like Goldman Sachs, JP Morgan, Bank of America, so on and so forth, have been hitting all-time highs. Why? Because an increase in Treasury bonds signals a potential increase in rates. Okay, for mortgage rates, for rates on someone's floating line of credit, so on and so forth, and that means more interest income in their pockets. Okay, for simply put. Followed by real estate. Okay, real estate sector has kind of also done a lot better over the last few weeks across March, but pulling back a bit. And of course, these three sectors have been outperforming the S&P 500. This bright, thick red line here. The S&P 500 is still up about 5.5% for the year. So still green for the year. Not bad at all. Okay, and then underperformance, we have the healthcare sector, utilities, and tech. Tech is, the most underperforming sector. I never thought I'd see it, but here we are, right? So it's really, tech's really kind of gone back and near break-even levels on the year, but still up about a percentage or so. Okay, so not too bad. All right. With that said, I want to open up the floor to some questions as I flip back to the S&P 500 chart. And one thing actually just reminds me before I get to the questions, I do have a couple stocks that I want to give people the opportunity to kind of just add or, note down to watch. Okay. First one, Visa. This one is one that I haven't mentioned anytime recently, so this one's very new in terms of me mentioning it. And take a look at what happened here. Visa plummeted on Friday, and not a good day Friday for Visa at all. One of the largest intraday single drops in quite some time. So this is something that I'm watching. I don't have a position yet, but something to consider. Definitely, the 200 area is looking very, very solid for an entry if it gets there. So it's something we want to keep an eye on for this week. Another one is a bit of a different kind of a suggestion, but not too much. I mean, I have mentioned an elite before, but no position yet, is Eli Lilly. Okay, one of their kind of drugs didn't have the best of preliminary testing results, and so it's pulled back. Okay, which is fine. These things happen. Eli Lilly is a fantastic company, great large cap, solid global pharmaceutical. Okay, major pharmaceutical company. It had an amazing run since 2021, start of the year, but it's getting to the levels just before this gap. Okay, it's pretty much retraced most of this rally. I would like to see it come down to 180. If it breaks below 180, that's going to be a bit bearish, and then next stop around 166. So I'm going to keep an eye on this. I don't have a position yet. Might do short puts on this and on Visa for those of you that are aware of how options work, and of course the Raptor method as presented in the options trading masterclass. With that said, those are the two couple suggestions, something to keep an eye on. I'm not too concerned. I'm sure opportunities will be presenting themselves as the week goes. Let's open it up to the floor and take some questions.
Here, but he says he's talking dirty words here, by the way. He says that his
Forex, what do we see here? People are typing.
He says his IG Forex guru hasn't posted in a while, and he wonders if he might be dead.
So meme jokes, sarcastic stuff in chat room. I have read it, but we will leave those aside for now. So someone is asking here that their mom would like to invest, and she has asked this individual to invest for her. The thought is to just put her money into the S&P 500 index ETF, and really just leaving it in there in an IRA. Is this a good idea? Absolutely a great idea, especially for more of a hands-off approach. And, you don't want to, be exposed to the ups and downs of individual stocks and just kind of casting a wide net, looking at doing it for long term. You're not looking to keep getting in and out, but so long as you're okay with getting in and scaling in, of course, or maybe it's one lump sum type of purchase. I don't know the details about that, but if that's the case, you're able to contribute, or she's able to contribute every so often, then absolutely, I would definitely at the very least consider buying on dips. Okay, and obviously it's subjective. When do you know we're in a dip or we're just getting started? No one does. But ultimately, on red days, on down days, maybe you want to start slowly scaling in, okay, with that cash pile in the account. Okay, I think this is one of the best ways to do it for the long run. Just don't expect to make a significant amount of money just yet in the short term. Okay, it takes years and years and years. Okay, so definitely a good plan. Simon's asking, do I see pharma coming back? I do at some point. We do know that things can take some time, right? Here we have the healthcare sector, not the pharmaceutical, but the healthcare sector, relatively strong, right? Over the last year, doing really well. But specific pharmaceutical companies that I hold, they have been recovering a bit, right? In fact, I've mentioned these companies, over the last few weeks, the last month, and they are doing well, right? And just kind of flipping through the charts here on some of them. Okay. Sorry, which my mind is blanking on me, but just running through a few here that you guys might want to perhaps consider or look at. MRK, perfect. Thank you, Chris. This is another one. GSK. All right, flipping through these bad boys for you guys to keep an eye on. I'm not saying, they're going to just rocket and go up to the moon like some of these high-flying tech stocks, but I don't care how long it takes, so long as they do continue to move up slowly but surely. These are, low volatility kind of stocks, They don't move too big intraday. But if you let the trade work, you let the position work, they can do really, really well in the long run. In fact, let's zoom out. You know what? Not the greatest of charts for some of these for the long run, but it doesn't matter. We're not planning on holding these for years and years, perhaps predominantly few weeks to a few months, right? So if some of these companies do get to certain resistance levels, absolutely I'm okay with taking it off. Maybe even if it goes higher, it's okay. I'm not looking to carry these for multi years. All right. Even if I bring back, Pfizer here. All right. Okay. So they go up and down, over a long period of time. If you can get the meat of the move, you're okay. If Pfizer maybe runs to 37, 38, I'm okay, taking the money. Maybe if I'm wanting to take some off, leave some running, definitely not a bad idea as well, right? So it's something that, it doesn't have to be complicated or complex. Just make sure that you have the time frame available for it. And ultimately, as I've said before, medium to long term is the way for these kinds of companies. Okay, don't expect fast money, don't expect large moves in either direction. All right, any other questions? Scrolling here, what's going on with PLTR? Great question, Chris. And ultimately, one that I am not surprised that you are asking, or if anyone asks, or is probably thinking that. Well, take a look at this. Some will say, well, Riz, this looks like a bit of a head and shoulders pattern, right? Like, in the long range, bit of a head and shoulders pattern. Yeah. So, you know what? I can't fault anyone for thinking that. Ultimately, the trade isn't going the best, especially after last week, right? Especially after last week. PLTR, Palantir is obviously a tech related company, and of course it has pulled back significantly since hitting all-time highs around $44. That was a bit too overdone anyways, but you know what, it's did well the week prior, and then of course with last week's market moves, especially the Nasdaq tech sector, it's moved back down to the 24 area. I think this is a good solid entry. The closer we get to the 22, 23 mark, sorry, that's not a straight line at all. But the closer we get to that level, the better I feel about an entry for those of you that are not in yet. Okay, I already am. I've already averaged in. I think around my cost is around here, about 23 or so. Okay, 23 and a half or so. I'm not too worried. I'm willing to give this some time. Okay. Tom asked me a question, and Aaron is also asking me a question. If one sec. Yeah, so Aaron mentions, one of these kind of companies that has significant positions in PLTR, and ultimately the question is, is it bullish or is it something that we want to do, buying companies and holding them when others are selling? It's okay. It's absolutely fine. We know that in PLTR, I've touched on it, that some of the executives, chairmen, CEOs have sold their shares once the lockup period expired. So it's not a bullish thing, of course, but it's fine because many of these companies go public so that they can have liquidity and easy access for insiders to enter and exit, the shares. I would also not be surprised the same happens where insiders start buying shares if this thing, maybe goes a little bit lower, and just as a way to show their confidence and show investors and individuals that, they believe in the company. They might have sold earlier, but that doesn't necessarily mean that the company is going under, it's bad, right? So I've seen it plenty of times, insiders and, CEOs, CFOs, management can sell shares, but guess what? Also because a large part of their compensation is shares. They need to sell some shares to be able to live the lives they do or whatever, right? So it's not necessarily all bad, okay? Tom is asking, March dividends post on IG today. I'm sure these stocks aren't in your trading account, but what are some dividend stocks REITs would be looking into? Honestly, really depends on what kind of investor you are and what your time frame is. But one ETF, someone can consider. I'm blanking out actually on the ETF here for the. This is one you can consider. This is real estate ETF. Has had a nice run up since COVID crash, really is what you want to call it. And in fact, the yield is a nice solid 4%, give or take. Okay, it's had a nice run, not exactly at pre-pandemic levels, but definitely a good run. You can consider this one. This is a low-cost ETF if you want exposure to broader real estate markets. I hold things like Enbridge. Obviously, you probably saw Pfizer. Again, not a surprise there. This is another great company. It's an oil pipeline company, Canadian company, but also listed on U.S. exchanges. Another one is this. This also is another Canadian pipeline company, and is listed on the U.S. exchange as well. So 6% dividend for this one, about 7% for Enbridge. If you are looking for some other dividend style plays, you can consider another solid U.S.-based pipeline company called EPD, and this one has about 8% dividend yield at this price point. Okay, so some things to consider. Ultimately, I don't buy companies because of their yields. I buy good companies, solid companies. The yield is a byproduct of a good company. The dividend is a byproduct of a great company. Okay, not the other way around. Okay, I get this question a lot, and it kind of irks me because people think I buy the stuff with the highest yields. No, it has to be sustainable. Okay, and it has to be a solid company. It has to be doing well, and it has to have a good track record. Okay. One other question I've gotten: Costco, PG, UL. These are all companies that we have traded in Elite. We continue to hold. UL I've gotten out of, but ultimately Costco and PG I still hold. These are companies that, again, look, we have seen them kind of come back up. We've seen them not do as bad as tech. We've seen them hold on to some of their support levels, and Walmart is another, right? PG, Procter and Gamble, right? Take a look at this. They're holding pretty well. In fact, tech didn't have the best of the week last week, but guess what? Procter and Gamble holding solid, right? So that's what we get. We get lower beta. We get some defensive and low volatility type of exposure with these companies, right? So it's okay for now. If you have the ability to carry. If not, you have to look at other alternatives that are more suitable to your time frame, more suitable to your trading style. I get it completely that someone who has a smaller account and just doesn't have the ability to carry for whatever reason these positions, and maybe they want to make money faster or do more in and out stuff. Well, yeah, they're not going to be wanting to hold something like Procter and Gamble or Pfizer, right? They're going to be looking for stuff like like maybe Tesla, or if they can, or maybe something like GameStop. Ultimately, it all comes down to someone's style. I've made my money over my 13 years. I don't need to chase a quick buck. I trade not necessarily to make the most amount of money I can in a given day or a week or a month. I trade in order to preserve capital, to of course grow capital, but also have it be sustainable. There's no point making $100,000, $200,000, $1 million, $2 million if you're not going to be able to keep it, or if you're not able to sleep because your portfolio moves up and down 10 or 20% in any given day. Okay, it's not sustainable. There's plenty of people who have and will continue to jump out of windows because they didn't position size correctly. They didn't understand what the fuck they were doing, and ultimately, it all is very much a personal decision. I never ever tell people to just do what I'm doing. I just simply say, look, I'm doing this. This is someone else's, prerogative, whether they wish to follow, whether they wish to take it as an idea, whether they wish to take it as gospel, or whether they wish to say, nah, bullshit. That's up to them. Right. Another question I've gotten, great question here. Amazon. So Amazon, one thing we know about Amazon is that I remember a couple years ago, maybe it's a year, maybe 2 years. I remember Berkshire, JP Morgan, and Amazon were looking into getting the more pharmaceutical stuff. And people were like, I remember pharma dropped because Amazon was looking to get into that line, and they didn't. So we know that Berkshire, Warren Buffett, JP Morgan, and Amazon kind of cooperation that was occurring to make this happen didn't happen, and it's actually been called off. Now, in regards to your question, does Amazon moving into telehealth, which is a really big area, hurt something like Tdot, or does it validate the space, which is a great question. It definitely validates the space, meaning it definitely shows you that this is an addressable market. This is a marketplace, telehealth, so to speak, that is, viable, is future proof, and it's kind of important, and it could very well coincide and coexist alongside the traditional health route. And I am not surprised at all Amazon is considering this or moving into it. Is it bullish or bearish for Tdot? I think this is relatively neutral. Okay, it's in one way, Tdot has a bit of a competitor on the horizon, potentially. We know Amazon also abandons their projects as quickly as it starts these projects too. So how they do depends very much on Amazon. But ultimately, Tdot is not going anywhere. It's here to stay. And this is also something that I have a position in, currently in the red, but it's fine, very, very near that long-term support around 180 area. So if you don't have a position, maybe you want to consider. Keep in mind, this moves big. Okay, this is actually a pretty high beta stock, pretty volatile stock on an intraday, and you need to be kind of aware that it does trade more so like a tech stock, and so just keep in mind that make sure that it kind of suits your risk tolerance. I really like it at these levels. I already have a position. So to answer your question, yes, I think it validates the space. I don't think Tdot is going to be too hurt by this. In fact, it's just, I would say it's more neutral to bullish than actually outright bearish. Okay. One of the questions I got, okay, Chris actually typed it in. So short puts, he's asking how I made money on short puts. And I guess because it's Chris, I cannot deny him this question. Okay, so let's do a quick breakdown of how I made money on LMND. In fact, when I shared my position, some people were like, really, you took a delivery, why? This is not really suitable in terms of a company that you would hold. It's not the most solid company. It's a growth stock. It's a recent IPO. Why hold this? And obviously in hindsight, it went well, but the trade I took on this was I shorted, this was maybe a couple of weeks ago, 2 or 3 weeks ago, I shorted the 100 puts here. Okay, actually, see if I can bring this. I took the 100 put option because there's some nice premiums. It made sense. I was okay with taking delivery at this strike price. This was probably, again, like I said, 2 or 3 weeks ago. I can't remember, right? So around here, the 100 strike price. Okay, I took this probably a few days to expiry, a week to expiry, so probably around here somewhere. It did go down, okay, it did drop, and it kind of went very, very near my break-even price and a little bit below. So instead of taking the loss, okay, I took delivery of the shares. So I took delivery of 100 shares of Lemonade at $100 per share. I'm not going to go into the details of how short puts kind of work and whatnot, but that's essentially what happened. I took delivery of 100 shares on the expiry, and it was Friday. Okay, so now once that happened, I'm now long, meaning I now own 100 shares of Lemonade. Okay, I now own 100 shares of Lemonade at LMND at $100 per share because I shorted the 100 strike. Guess what? I also got paid for that, right? I got paid for shorting that contract. So, it's probably $1 or $2 per contract. So 100 or 200 bucks. Great. That's fine. I essentially took delivery of a stock that I already wanted to. at the price that I liked. So what happened then was the following week, the stock rallied nicely, went around about 108, 109. And what I did was I said, you know what, I'm okay getting out, but instead of just selling the 100 shares and making about, $800 profit or so, what I did was I shorted a call option. This is known as a covered call because I already had 100 shares. I did a 110 strike call. I got paid for taking that call option, okay, as a hedge. What happened? The stock closed a little bit above 110. And it was about that area. And I said, okay, what? I'm taking it off. And guess what? The shares were assigned, gone. Okay, made give or take $900 to $1,000 on the options. On the stock, plus $100 or so, $100 to $200 on the short put, and maybe something like $100 or something like that on the short call. Okay, so total I made about $1,200 or so on this trade for something that really I think worked out beautifully in terms of a perfect short put, taking delivery followed by a short call. If it ever has to work out this way, this is one of the best ways. And it worked out just in time before last week's pullback. Okay. If it didn't happen, I would be stuck with the share that would have still been just about break even. Okay. Because my cost was at $100 and the stock price closed at $99.70 on Friday. Okay. Another question I got is by Rajiv asked, been hearing Etsy and Amazon like 10 years ago. This is something interesting here. I think that Etsy is definitely had an amazing 2020 and of course a pretty good 2020 so far as well. I find like everyone, is trying to identify the next Amazon. There is not going to be a next Amazon. The point is you're essentially looking for the next 10 bagger, multi-bagger, something that's has tremendous growth. And sure, this could be it. But I also look back and think, what's your time frame? For the next 10-year hold? Maybe, right? For a few months hold, I am not too confident in entering right now after it's had a tremendous run up in the last year. To give you an idea, from March last year to now, it has had about, okay, let's just kind of start here, about a 330% increase, even after this bit of a pullback from 250 high. So sure, it can be the next Amazon. Anything can be the next Amazon. It depends on your time frame, right? If I held Amazon in, I didn't, but if I held Amazon, back in early 2000s, would I have carried it all the way now? Likelihood is most people probably wouldn't have. They probably would have gotten out, maybe gotten in, gotten out, so on and so forth. So it's like the whole phenomenon of looking in hindsight. Would you have held Amazon? I wouldn't have even held Amazon, and it turned out to be the next Amazon. Okay, so really, it all comes down to time frame, and of course the stock itself. Etsy is not looking like being the next Amazon just yet. Okay, it doesn't have what Amazon has had over the last 10 years compared to where Etsy is at. Okay, hopefully that makes sense. Technically, really anything can be the next hit stock. I think we're in kind of a twilight zone with some of these tech companies, whether it's Fiverr being the next kind of thing. Look at this thing, right? Like it's look at it, IPO'd last in 2019 and just $30. And we want to talk about return. And since let's just go from a year out. Okay, how's this for that? Is this the next Amazon? Fuck no. Not with them taking percentage cut of a $5 gig work. No, I mean, the people, especially in developing economies, have done really well because of something like Fiverr. They get to make a solid source of income where they couldn't. But is it the next Amazon? Fuck no. Right. So it all depends. Some people say Shopify could be the next Amazon. This could be the next Amazon. That could be the next Amazon. Riz International could be the next Amazon. I'm joking. But ultimately, you know what? I don't fall for these kinds of things. Everyone thinks so-and-so could be the next Amazon. In fact, the majority of people betting on what the next Amazon could be probably wouldn't have bought Amazon when the time was right. I didn't buy Amazon, last year or the year before, the last 5 years, last 10 years. I wish I did, but I didn't. So what does that mean? It's not easy to pick the next Amazon, even if it's Amazon. Okay. All right. So with that said, I'm going to leave it here. It's been great to be on again. I appreciate the questions. I appreciate you guys joining. And for those of you, whether in your elite or whether you're watching this outside, you're watching the recording afterwards, I appreciate that. I hope you've enjoyed it. I hope some of my inputs and insights may not be the most, I would say, nicest or politically correct or let's just say with a cherry on top, but it is blunt. It is what I believe. It is the way I speak, and I think everyone is better suited for it because there's no point kind of sugarcoating stuff, right? So I hope I didn't hurt anyone's feelings. It's just kind of a way I have to put things in perspective and get to the point. And with that said, it's been a pleasure. Thank you so much to everyone for coming on, for your questions, for your support. It means a lot to me. I know I say these things often, but honest to God, I can say, I mean, life's not, a bunch of roses and rainbows. I'm not farting rainbows. I'm not, out here vacationing on a yacht in some, coastal waters. It's been a great 29 years. Sorry, forgot my age. It's been a great 29 years. And honestly, I thank all of you for making it such, because life is too long. It's too long to be doing something you don't want to do, but too short when it comes to doing things you love doing. Okay. Let that sink in. I leave that with you. Thank you so much, everyone. It's been an honor. Take care. Ciao.